Jamie Trull here, your favorite CPA and financial literacy coach. And today we're going to be answering a question that I get all the time, which is, what should I pay myself in an S Corp? If you are an S Corp owner and you're not sure how or what to pay yourself, we're going to go over the different options here. And it can get a little bit complicated, but hopefully I can really make it easy for you to understand. So if you're watching this video, you've probably already elected to be taxed as an S Corp, or you are about to do so. So I'm not going to go into all the ins and outs of what makes an S Corp different, whether it's right for you. This video is really going to be specifically about how and what to pay yourself from that S Corp. But I have tons of other content about S Corps and if it's right for you on this channel. So make sure to subscribe and go check that out. So jumping right into it, there are 3 general ways that you're going to pay yourself as an owner in your S Corp. And the first way is through salary. That's also called reasonable compensation. That's typically paid through payroll. The second way you're going to pay yourself is through owner distribution. So that is amounts above and beyond your salary that you make in profit that you can take out kind of like owner draw, like you would in an LLC or sole proprietor. And the third way is through reimbursements. And that's a really great way to be taking money out and get tax advantaged money out of your business for reimbursing yourself for expenses that you paid on behalf of your business. Now, determining how much to take out in each of those different buckets can be the difficult part of this, right? And so really understanding the rules that the IRS has and also what their audit triggers might be, because we do not want an audit trigger. We really would prefer to stay away from it. Audit isn't the end of the world, of course, but we really don't want to trigger an audit. So what can we do as S Corp owners to make sure that we're not overpaying in taxes, but we're also not putting a target on our back for the IRS? So first, we're going to dive into a little bit more detail on each of those 3 different ways and what you need to have in place in order to support what you're doing and also to determine how much to pay yourself through each of those buckets. And then also we're going to go over some of the common mistakes that S Corp owners make and how to avoid them, because I think that's really, really important to address as well. So let's start by diving into that first bucket, which was salary. Okay, so for most S Corp owners, you're going to need to pay yourself a salary, i.e., you want to be on payroll as an employee of your business. If you have an S Corp, that means that it is a corporation that is separate from you. So any work that you are doing directly in your company essentially is work that an employee is doing. Okay, so unlike a sole proprietor or an LLC where you are not actually technically an employee of your business, you're only the owner. When you are an S Corp owner that works in your business, you are both an owner and an employee, okay? So you can pay yourself in those 2 different ways. So when we think about those first 2 buckets, that's a good way to think about it. That salary bucket is what you're getting paid for being an employee of your business, for the direct work you're doing in your business. The second part of what you're getting paid, your distributions, is generally going to be coming out of that above and beyond profit that you have above what that salary amount is. So that's going to be more payment for essentially being an investor in your company, right? You're ultimately getting a dividend, let's call it, for being the person who's taking on the risk in your company. So I think that's just the easiest way to think about it. How much are you paying yourself as an employee? How much are you paying yourself as an owner, right? And when you look at what you're paying yourself as an employee, the IRS has a lot invested in making sure that you're paying yourself enough. They typically aren't going to care if you are overpaying yourself in salary most of the time, because that means that you are paying full payroll taxes on that full salary, right? That is the least tax advantaged way to pay yourself, is via payroll. So you're going to have income taxes, you're going to have payroll taxes, self-employment taxes, you're going to have unemployment taxes, you're going to have all of that on what you're paying as an employee. Weirdly, right? Employees are actually taxed at a higher rate than owners and investors. So that is something to know when you are setting your owner's salary, is that a lot of times, if you're trying to save the most in taxes, if that's a goal of yours, if that's why you're becoming an S Corp, you don't want to set your salary super duper high such that you don't take any distributions out, right? That you're only taking salary, because then all of a sudden you're really not getting a benefit out of being an S Corp. The benefit of being an S Corp comes when you have profits in addition to the amount you're paying yourself in salary. And those profits, the distribution, that's the second bucket, is taxed at a lower rate because there are no self-employment taxes. You still have to pay income taxes, but there is no self-employment tax. There's no payroll taxes. There's no Social Security, Medicare, all of that. That's what we're talking about here, which is about 15.3%. So that's where your savings comes in. So that's why the IRS wants to make sure that your reasonable salary is high enough, that you're paying yourself via payroll for the job you're doing, not an unreasonably low amount. So one red flag, right, to the IRS that you're not paying yourself enough is if you actively work in your business and you are showing nothing for salary paid to yourself as an owner. That's a big red flag. Or if you're showing hundreds of thousands of dollars in profit and you paid yourself $15,000, right? That probably is an unreasonably low amount unless you're barely working in your business and it's being entirely managed by your employees. So a lot of times that's something we need to think about is how active are we in our business? If we're working 40-hour plus weeks in our business, which honestly, I don't know that many entrepreneurs that aren't. If we're doing that, then we should be paying ourselves commensurate with that. So how do we figure out reasonable salary? Well, ultimately, it is about figuring out what you would pay an outside person to come in and take over your role, which I know is really difficult for most of us that are small business owners because we wear about a bajillion hats. Like, I absolutely know that for me, where I do a lot of different things in my business. It's a very small business. I have myself and 3 other employees, right? And I do a lot of various different roles within that business depending on the day. And so how am I supposed to determine what I would pay somebody to come in and do my job? Well, there are ways you can do that. And ultimately what they want you to do, especially if you're in a role where you have many different hats, is to use an approach whereby you are looking at what you would pay each individual role and then essentially doing a weighted average of that over the amount of hours that you work to determine what that salary would be. So it's basically a big calculation that requires a lot of knowledge of what those job roles would pay, what your proficiency level is at those job roles, where you live, right? A lot of data that might be difficult to just go out on Google and find. So one of the things that I do, because I know that this is becoming an area that the IRS is looking more and more at, and for good reason, they're trying to close that tax gap that exists between what they think should be paid in taxes and what people actually are paying. And too low reasonable salaries is one of the ways that this tax gap exists. And so what I do is I want to be really supported. If the IRS comes knocking, I want to know that I have support for what I'm paying myself as salary in my business. So I've actually partnered with a company called RC Reports, and I'm going to be partnering with them to help you as well. So I do this for myself. I run a reasonable compensation report for myself. It's really cool because I can go in there, pick some of the things that I do in my business and about how much of my time I spend doing it, and it pulls all the salary data and amalgamates it together and creates a beautiful report. And the report that you're going to get on the back end is going to help you to be able to have that support and have all of that data and where it came from all really clearly put together such that you have it in case the IRS comes a knocking, right? And you also can have just peace of mind knowing that your reasonable salary is reasonable. Now, this is something that I recommend people do every single year. If you have not relooked at your reasonable compensation since you set it 5 years ago, or maybe you've been using one of those rules of thumb that some accountants and CPAs will talk about, which are not supported by IRS guidance, by the way, then you might want to dig a little bit deeper and get one of these reasonable compensation reports to make sure that you're protected. So I've partnered with them. Go to jamietrull.com/RC reports. Okay. And you can see I sell it for a heck of a lot less than what other accountants out there would sell something like this for. And I also review each and every one. So I'm going to give you tips. I'm going to take a look at your report once it's run and let you know what observations I have, maybe some places where you might be able to save some money on taxes. I will be looking at each and every one of those and corresponding with you about it. So it is a great time right now to be looking at reasonable salary, whether it's for the current year or for the year that's coming up, because you want to make sure that you have full line of sight on what that's going to be. If you need to make payroll changes, that you have time to make those changes. That is what I highly recommend that you do if you are an S Corp trying to figure out what your reasonable salary should be. Now, let's quickly talk about the second way to pay yourself. And I've already touched on this a little bit, but that is through distributions. And that is one of the best ways to pay yourself, especially when comparing it with salary. So distributions are going to be profit that you made above and beyond that amount for salary. So let's say that I made $100,000 in profit in my business, and maybe through running this report, I realized that my reasonable salary should be $70,000, okay? And so I paid myself $70,000 through payroll, and then that means that I have $30,000 of this year's profit that I can take and pay myself, which generally should be tax-free, right? Your profits, if you're not taking out more than you ultimately profited, i.e. your basis in the company, you should not have additional taxes on that. Now, you will have to pay income taxes on that profit in general, right? But you don't have payroll taxes, i.e. self-employment taxes, Social Security and Medicare, that's all in that realm of self-employment taxes. You don't have that portion on any amount you take out as a distribution, i.e. a dividend. Okay, so that's kind of that piece of the puzzle that is what you get to take out for investing in your company, for being an investor. You've got your salary for being an employee, you've got your distributions for being an investor, and those are tax advantaged. So you want to be able to have more on that side if you can, right? So oftentimes, again, what people want to do is to be able to justify a lower reasonable salary, but it has to be reasonable, right? And therefore have more money they can take out of their business at a lower tax rate. That's where the tax advantages come in with an S Corp. And now really quickly, I will also talk about the third way to take money out of your business. And that is actually the most tax advantaged way to do it, which is as a reimbursement, right? So there are various different business expenses that you can reimburse yourself for, but you have to do it the right way. So that's the thing where we can't just reimburse ourselves willy-nilly. We have to have the documentation. We also have to have what's called an accountable plan in place, which is essentially an employee reimbursement plan, right? So we can't just be sending money from our business to ourselves and reimbursing it. I do run this through my payroll, and there's usually going to be a special type of compensation through payroll for reimbursements, but you have to make sure that you are keeping all the documentation on file such that, again, if the IRS comes back and says, show me that this truly was a reimbursement, if you can't provide that, they're going to reclassify that as taxable income, okay? So reimbursements are going to be non-taxable because they're just paying you back for money you spent. So if you have home office expenses, for instance, if you have car expenses for your personal car that you're using for business, right? Those types of things. In some cases, and this gets a little complicated, but in some cases, health insurance might be something that you could reimburse yourself for, right? Talk to a CPA about your specific situation. So I always make sure that I'm reimbursing myself for all of my actual expenses, that I'm paying attention to what they are, because that's tax-free money, totally, right? I would rather have fully tax-free money than salary or distributions, which at least have some element of tax to them. Now, if you have an S Corp or you're thinking about an S Corp and you're like, I don't even have an accountability plan, I don't even know what that is, we talk about that in my S Corp Toolbox. So that may be the perfect thing for you. We actually have a template that we link to where you can use that as a starting point for your own employee expense reimbursement, i.e. accountable plan. So go check that out at jamietrull.com/S Corp Toolbox. And if you also want to get the reasonable compensation report I talked about earlier, we have a bundle where you can save money if you buy both of those. So you can get the full toolkit that has a whole bunch of checklists and guides and templates and video lessons, and the reasonable compensation report for less than if you bought them separately. So go check that out, jamietrull.com/S Corp Toolbox. So before we go, I want to touch on some of the common mistakes that S Corp owners make when it comes to determining how much and how to pay themselves, okay? And this is just really important. I've touched on a few of them, but I really want to drive home this point as to the what could go wrong, right, in this scenario. So you've probably already guessed it, but one common mistake is paying yourself too little in salary, i.e. reasonable compensation, okay? So that is one issue if you're not paying yourself through payroll at all, if you have not figured out this reasonable compensation, right, and you're just paying yourself entirely out of distributions just like you did maybe when you were an LLC or a sole proprietor, that is a red flag. And if you are audited, almost definitely that is going to be something that will get reclassed and you will have additional back taxes and penalties and things like that you're going to have to deal with. So you definitely want to make sure you're not paying yourself way too little. Now, the other mistake though that people make is paying themselves too much. Okay, remember that S Corp benefits really kick in when you are able to pay yourself distributions from profit above and beyond what you're paying yourself in salary. And if you're paying all your cash out in salary that you don't have any left to pay yourself distributions, well, you might not be really even getting a benefit from being an S Corp. And you might be paying yourself far too much. Okay, so that's something to know, is that if you haven't done this detailed work, right, or if you're using some rule of thumb, it might be coming up with a number that is way too high. And this can have a really big impact. Using a back of the envelope, which I'm not usually a big fan of back of the envelopes, but for the purpose of this video, because I don't know your numbers, I'm going to use it, right? A $6,500 reduction in salary typically will yield about $1,000 worth of tax savings, okay? If, let's say, you were paying yourself $56,500 as your salary, well, if you could justify taking it down to $50,000, that would save you $1,000 in taxes. So that's just something to know, that is really common as well, is paying yourself more than you really need to. Now, some people choose to do that for various reasons. Maybe it's for Social Security reasons in the future. Maybe it's for, additional other loans or things like that you're trying to get. But for the most part, most business owners, if you're strictly looking at it from a tax perspective, benefit from setting their reasonable salary at something that is reasonable, but not too high. And then the last mistake, probably not the last mistake, but the last mistake I'm going to talk about today is not documenting things properly. So whether that be your reasonable compensation, right, and how you came up with that, or documenting in your accountable plan how you are reimbursing yourself and what for, and justifying what those reimbursements are, right? Those are things that can really trip you up down the line. Now, of course, some of us are totally fine rolling the dice, whatever, if we get audited, we'll figure it out later. But I am a big fan of being prepared. And if you're watching this, you have no excuse anymore. If you've seen this, you have no excuse. You got to get your ducks in a row. So if anything in here has sparked you to say, oh my gosh, I haven't done that, then you're gonna want to do that. Because again, if you get audited, even if it's down the line, it could still open up back years as well, right? So just because you haven't been audited yet doesn't mean you won't be. I don't wanna freak people out about audits because I don't think they're the worst thing in the world, but I do think you wanna have your ducks in a row. You wanna have your documentation done, okay? In the old auditing world that I was in, the quote was, if it isn't documented, it isn't done. And that's how the IRS sees it. It's going to be really hard to scramble 5 years from now to figure all of this out. It's much easier while you're sitting in the moment to take these steps to protect yourself and to have the best defense that you can. So thanks so much for joining me. Definitely go check out the S Corp Toolbox and the Reasonable Compensation Study and Report. This is a really great time to be looking at all of that and getting everything organized. And then make sure to go check out some of our other content. We have lots of content on reducing your taxes, on getting organized with your finances, on making more profit. So make sure that you check out all of that and that you like and subscribe. And thanks so much for joining us. Bye for now.